Hello, friends. If you're looking forward to a very intellectual, data based, incisive, and accurate analysis of the market, you're at the right place. I'm Vijay Bimwani, and in this video, I'm going to decipher the message of the markets for you using our in house exclusive indicators and studies that you won't find anywhere else on the internet. Let's plunge right in. And the first thing that you see on the market roundup window is that the bulls are attempting to fight back. They are basically trying to resist big ticket declines, and that is borne by the fact that the Nifty 50 rose 2.37%. Do remember it's a broader based index as compared to the Bank Nifty. And as my last week's video thumbnail itself said, a fortnight ago, that the banking stocks could weigh on the markets. And sure enough, the Bank Nifty gained only 0.4%, whereas the Nifty 50 gained almost 2.5%. What is evident is that the US dollar index continued its upward march, which is, as I've said in my past videos, a negative for emerging markets, including India. Mercifully, the cues coming in from the commodities space is that the nerves of traders are much more calmer. They are basically not fearing supply disruptions as much as they were at the beginning of the Russia-Ukraine crisis, the war. So oil and natural gas prices falling is always welcome, and the markets are basically calming down. And the same thing can be said of base metals. The runaway rally that you saw in base metals, which was triggering fears of inflation, is now calming down. The price discovery mechanism is getting much more smoother. Of course, it's way beyond, it's still far away from the equilibrium point where we want it, but it's getting better and better every week. The US dollar continued to rise against the Indian rupee. It gained 0.35%, and bond yields went up because inflationary fears did remain on the horizon, but it was not as sharp as it was in the previous weeks. The NSE actually gained 2.5% in market capitalization, which is not a surprise because the underlying tone was of buying. The MWPL continued to rise, which is very normal after an expiry because till the third week of the derivative cycle, MWPL continues to go higher. So there we are basically just not surprised at all. Now let's take a look at the overseas cues. The Dow Jones continued to fall. The Nasdaq, of course, witnessed a far sharper decline, almost 4%, whereas the Dow fell only 2%. Do remember that I had shared a Nasdaq chart with you where a death cross was indicated a fortnight ago. You can see it on your screen. The Dow Jones is not there yet, but it may be one or two sessions of a decline away from there. So a death cross coming on the Dow also could weigh on the markets. The S&P 500 fell almost 3%, and that also is a sign of concern, which is why the rally in India was fairly muted. Now, what you can see on your chart is the MWPL chart again, and you can see that it's heading towards the 26-27%. That is what I expect in the coming week. But the peaks that we used to see in October and November of 32, 33, and 34% still seem evasive, in spite of the fact that this is 2 weeks into the month of the new derivative cycle, and traders are not taking big ticket exposure just as yet. But things can change. So we're going to keep this metric on our horizon. And I update all this data on my social media accounts every single day. Do connect with me. My contact coordinates are appearing on your screen. And we basically provide this data in very easy to understand format. Even a fourth standard school child will be able to understand, as you can see. We also have a free WhatsApp broadcast update service for you. In case you want, you can send me a WhatsApp message on this number and we'll get you going right away. Provide your full name and email ID and you're on. Now let's take a look at the stock and index futures turnover. This is the cumulative turnover of 3 derivative cycles, that is March, April and May. Index futures have seen a sharp decline in turnover and so has individual stock futures, which is not exactly very good news because barring Monday, Tuesday, Wednesday, Thursday, and Friday were days when I saw optimism, some kind of a clawback of the bulls trying to come back, and yet the volumes did not really rise much except on Thursday. So I want to watch for the volumes, and this is a function of the one Marshmallow traders. The Marshmallow theory is explained in another video. The hyperlink to that Marshmallow theory, one Marshmallow or two Marshmallow traders, is in the video in the description below. Now, let's go to the prompt futures basis analysis. By prompt futures, I mean March month futures, the prevalent futures. What we are seeing is that the Bank Nifty's basis is nothing but the premium enjoyed by the futures over cash. The Bank Nifty's basis has been falling right from Tuesday onwards. That's because as and when the Bank Nifty was rising, more and more sellers were emerging at higher levels, not expecting it to sustain. And of course, there was delta hedging going on there. So the futures premium has shrunk. The Bank Nifty, on the other hand, you can see that right from Tuesday onwards, the premium has risen. The basis has risen. So there's been short covering in the Nifty 50. Now, Nifty 50 is a broader based index, and I told you keep an eye on inversion. Inversion meaning the future being below spot, which is negative. Only on one trading session throughout the week, last week, we saw inversion, which is good. As long as the Nifty remains into positive territory and continues to rise, I would say that the bulls are optimistic and they are willing to pay a higher premium. So let's keep an eye on this basis as well. I update the basis on my social media account every day, so do connect with me here. Now let's see the NSE advance decline ratio. Good news here as well. And on 4 days out of 5, we saw an NSE advance decline ratio exceeding 1, which means for every gainer, there is a loser. So it's been above 2 on an average throughout the week, which means for every 1 loser, there's been more than 2 gainers. And on Friday also, where due to the weekend, traders tend to be cautious, the advance decline ratio is 1.6, which means for every 100 losers, there are 160 gainers. So I think the one Marshmallow traders, in spite of the fact that they've participated less as the volumes have told us, the advance decline ratio says that the bulls are actually trying to claw back. Now let's take a look at one of our most reliable indicators from our statistical trading module, the impetus. You've been trusting it for many months now, and what you have seen has stood the test of time. And here we go. The impetus chart tells us that in the initial part of the week, when the market was trying to find its feet after falling on Monday, the rally was led on falling impetus. But on Friday, when the markets have risen, after the election results were done and dusted, they were digested, the impetus for both the Nifty and the Bank Nifty has risen. That tells me that the rally on Friday was a little more convincing than the rally from Tuesday to Thursday. Now, if the impetus was to continue rising along with the prices of the Nifty and the Bank Nifty indices, we are going to see a better sustainability of the upthrust. So watch this space very carefully. As and when I feel the impetus chart needs to be updated, I will put it up on my social media account or even provide it via WhatsApp in my broadcast list. Like I gave you the contact coordinates of the broadcast list, please feel free to send me a message with your name and email ID and we'll get you going right away. It's absolutely complimentary and free of cost. Now, for the latest indicator that you've learned to trust as much and maybe even more than the impetus chart, I am talking about the LWTD, the lift weight thrust drag indicator. Note how on Friday, the lift weight thrust drag indicator is above zero again, in spite of the fact that the Nifty witnessed some selling pressure at higher levels, and the Nifty itself, which is indicated by a blue line, is showing declines in percentage gain over the previous day's percentage gain. So what you're basically seeing is the Nifty spot, which is plotted as a blue line, showing the percentage gain or loss over the previous day. So even though on Friday it gained, the percentage gain was smaller than Thursday, which is why the Nifty shows a fall. But LWTD, in spite of that, is telling me that from Wednesday onwards, where it bottomed out, Thursday it was almost a little below zero, but on Friday it is unmistakably above zero. So what is the implication? I think this is a thrust, either a weak thrust or a weak drag, but it's definitely not weight, and it's not yet time to call it lift. Don't get confused by the terminology that I'm using here. This indicator is covered in a fantastic tutorial all about the LWTD indicator. It's there in the description below the video. You can find a hyperlink to that video. Also, it will appear as a link in the end screen at the end of this video. So the LWTD indicator is again something that I update on social media every day. It's changing day on day and you must watch it every single session. So what I'm showing you now is valid only for Monday. Now let's take a look at the footprint of the four types of traders in the market. I begin with FIIs. They've raised their stock futures net long positions marginally, very marginally, and they've also covered their index short futures substantially. So what they are doing is that they are selling in the spot in deliveries, and they've raised their long positions very, very slightly in the futures space. Now, domestic investment institutions, the DIIs, here again, they've cut their short positions in the index futures, but they remain net short. And as far as their individual stock futures are concerned, here again, they remain net short, but their short positions have been squared marginally, and they are basically covering their shorts all through the week when the market was rising. Now let's see what the prop traders are doing. Why are prop traders important? Because these are brokers' own proprietary trades. These guys are second best to insiders because they know who's buying what and how much and at what price, and therefore their trades are super sharp. The prop traders have hammered the indices on Wednesday, Thursday, and Friday. And Thursday and Friday, they've actually gone into net short on the indices. And as far as their individual stock futures are concerned, they've reduced their stock long in their futures positions substantially, as the decline tells you. Here again, Tuesday onwards. Remember, the market was attempting to rise from Tuesday. It opened with a third on Monday, but Tuesday onwards, when the market was rising, the prop traders were unwinding their long positions. So they somehow don't seem to be very gung-ho about it. Now, for retail individual traders' footprints, they've reduced their index net long positions marginally, but they've continued to unwind their stock long positions gradually. Now, do remember that the retail has been doing all the heavy lifting so far, and their actions can have a bearing on the market because their long positions are substantial enough to impact the market sentiments. If they start unwinding in a very rapid manner, that can definitely have some impact on the market. Friends, let's now go to the bond market, the a very critical area of the markets, which are unfortunately neglected for the simple reason that people find bonds very boring. But this is the source of all money supply for other asset classes. And week on week, we saw 1 basis point rise in bond yields, but the fact remains that the market expects inflation to remain elevated, and at some point in time, interest rates might just be tweaked a little bit. Now, let's discuss about a very critical aspect as to why I said the bulls are attempting to claw back. Some weeks ago, it was announced in the media that the government might consider postponing the LIC's IPO. The fact that LIC's IPO is a major reason for Big Brother to come and support the market is not a secret. And when LIC's IPO was expected to be postponed, it was the market traders' cue. Hey, the biggest supporter of the market is now playing cautious, so maybe the market won't rise, or maybe it might even fall. But now the LIC IPO is back in the reckoning, which is why you're suddenly seeing bond markets are a lot more stable as compared to what would have happened under these circumstances. And the US dollar versus the Indian rupee is not running away. So the INR is relatively calmer than where it should have been. So the bond markets are indicating here again that barring unforeseen circumstances on the war front, the bulls just might edge a little higher and might regain some lost ground which they have surrendered in the recent weeks, which is actually good news. Friends, the bond market's done. I now come to the Dixie, the US dollar index, a very critical benchmark because it impacts the prices of commodities, currencies, bond yields, and our equities. What you can see on the daily chart on your screen is that the Dixie gained on 3 out of 5 trading sessions. It wound up with 0.63% gain on a week on week basis, and the price continues to remain above its bullish trend line, which I plotted in the month of May, late May 2021. The price also remains above its 25-day exponential moving average, which is a month-long holding on cost of the bull. So even the short-term outlook remains positive for now. Even though the big bearish candle that you see of Wednesday, the third last candle, was a substantial large candle, but Thursday and Friday saw a clawback of the bulls, and the US dollar index is now probably, I'm using the word probably, attempting to go towards the 3-digit 100 mark, and that is likely to be a factor that will keep pressure on emerging markets, including India. So watch this space. Going to the weekly chart, we are now seeing that the last weekly candle was a bullish candle, but not as big and as powerful as the week prior. The price remains above its 25-week exponential moving average, which is a 6-month holding on cost of a bull. So the medium-term outlook also remains positive for now. And as long as the price is staying above a round number, which is 97.5 to 98, maybe 98 preferably, I think the bulls are still fairly comfortable. Now, last week, I advocated a range between 99.80 and 97 and a quarter, which held perfectly well in spite of all that volatility on the war front. And in the coming week, I expect an estimated range between 100.40 on the upside and 97.80 on the downside. Friends, the dollar index done. I now go to the bank Nifty, which gained 0.4% on a week on week basis, and it rose on 4 out of 5 trading sessions last week. And what you can see is that the broadening pattern that I have made on the daily chart, where there's a horizontal line which is absolutely flat, and there is a upward sloping line which is starting from June 2021. That's a broadening pattern. And what you are seeing is that the price had fallen below the 34,000 level, which I had advocated as a red flag if it happened in my previous week's video, which it did, but the prices have managed to claw back above this level. Also note, there are two oblique trend lines, blue ones with BARR written, bump and run reversal. 2 years ago, the weekly market outlook used to be a PDF format report, which I used to send out via WhatsApp. And those of you who have been with me for a couple of years, and I've been sending out this weekly market outlook since many, many years, will remember I used to also send you tutorials about how to decipher trading and technical analysis signals. One of them was the BARR, or the bump and run reversal. Do note how when the second trend line of the bump and run reversal pattern, when it was violated by a red candle, how the bank Nifty has fallen sharply thereafter. Do also remember that lesson on bump and run reversal as to what happens when the prices start to go up and they cross the first trend line. Now, just for your information, the first trend line should be hit somewhere around 37,600. Long way to go, but that is where resistance is expected. As in when the bank Nifty approaches this level, I expect resistance to come thanks to the bump and run reversal pattern. Do remember what I told you in the bond segment, that LIC's IPO is back in the reckoning, and that is one major aspect for the market to consider. Therefore, this is why prices are holding on for now. Let's now go to the weekly chart on your screen, where the last weekly candle is a bullish one, a green one. And what you can see is that the price has clawed higher above the 34,000 round number, which I had told you would be the critical area to watch, because any closing below this threshold would be a negative point. Exactly like the weekly chart, where the price is still below its 25-day exponential moving average. Exactly like the daily chart, where the price is below its exponential moving average, 25-day exponential moving average. Even on the weekly chart, the price is below its 25-week exponential moving average. On the daily, it represents a 1 month holding on cost. On the weekly, it represents 6 months holding on cost. So the bulls are not yet out of the woods, at least on the bank Nifty. So upsides are likely to be encountering a little bit of overhead supply, where people who are trapped at higher levels will attempt to unwind their long position. So that is something you need to be careful about. Friends, in the week before last, the bank Nifty was number one on the most volatile counters list on the NSE derivatives segment. Now that's really very, very dangerous, like I had told you last week itself. An index being number one in the most volatile list tells you that the markets are extremely jittery, they're extremely challenging for traders, and you could get cut both ways, long and short. Last week also, the bank Nifty retained that spot as the number one volatile counter in the derivative segment. So be extremely careful, trade light, and maintain stop losses at all costs. Otherwise, you might witness a deep drawdown on your capital. Last week, I advocated a range between 36,200 on the upside and 32,500 on the downside, which was breached lower because the intra-week low was 32,150. I was off by 350 rupees, almost a percent, thanks to the war volatility here. The coming week, I expect a range between 36,475 on the upside and 32,600 on the downside. I again remind you, trade light, the Jensen's curve, the Traynor ratio are not really very conducive to aggressive long positions in the leverage space. So let's be careful out there. Friends, I now go to the Nifty 50, the most liquid counter on the NSE derivative space, and it gained 2.37% on a week-on-week basis and rallied on all 4 days out of 5, all of 4 days out of 5, which is commendable. And what you can see is that there was a gap down, and then promptly the bulls made a great attempt to come back. Like I told you, they are shrugging off fears of war. LIC's IPO is back in the reckoning, and oil prices, along with other commodities like base metals, etc., falling, had a very positive rub off on market sentiments, which is why the bulls are feeling a little more hopeful. Now, the price remains below its 25-day exponential moving average, which is a 1 month holding on cost of the bull, but it's almost there. Also note how the price, which had fallen below the triangle formation which I have drawn since the end of January 2022, is also holding as a resistance in the immediate future. Once the price climbs above the 16,800 mark, this triangle resistance will also have been overcome. So the short-term moving average along with the triangle resistance being overcome will lend further credibility if and when it happens to the up move. That's something we need to watch out for. Going to the weekly chart, the price remains below its 25-week exponential moving average. That's a 6-month long holding on cost of the bulls. So the medium-term outlook also remains under pressure. Do remember what I told you last week. This is probably the first serious correction to be hitting the markets after this rally started in end of March 2020. So this is not something that you want to shrug away or take very, very lightly. But like I said, the bulls are attempting to fight back. And there is a big power candle. Do remember what I told you last week in the video. Power candles are those candles which are significantly larger than the recent ones, and they have a sizable amount of ground covered in them. So the last weekly candle is a power candle which has completely engulfed or dominated the prior week's bearish candle. This is called a bullish engulfing pattern in Japanese candlestick charting. Now, if follow-up buying comes in the coming week, bulls can build on this gained ground and possibly push the indices higher. The closer the index gets to 16,800 to 17,000, I think there will be temporary selling by people who are stuck at higher levels. And if the Nifty manages to cross the round number of 17,000, the scenario could change for the better. Now, in the week before last, this index was number 9 on the most volatile list, and it fell 1 notch to number 10. It's not that the volatility of this index has fallen. It's just that individual stock volatility has kind of expanded day on day, as you would have seen in the markets if you're sitting in front of your computer terminal. And which is why this index is at number 10. Last week, I advocated a range between 16,875 on the upside and 15,600 on the downside, which held perfectly because the interweek low was 15,671. Barely 71 points away from the support that I mentioned to you. So if you're an option writer, if you had written puts somewhere close to like say 15.4, 15.5 strike prices, you would have got fantastic returns on the Nifty itself, because the ranges, when they hold, when they start giving you predictability or a sense and sensibility, you suddenly have an edge over other traders in the market who do not have these levels working for them. This, I believe, is one of the biggest factors that works in the favor of statistical trading models, and which is why we make IBEX as a trading model that focuses to stay ahead of the crowds. Now, the coming week, I expect a range between 17,300 on the upside and 15,950 on the downside. Why is the range so wide? Am I trying to play safe? Am I basically trying to protect myself by saying, okay, let me give such a big range that I cannot go wrong? That's not the point. The point is the base effect. Look at how much the Nifty has gyrated last week. So the base, the intraday intra-week volatility base is big. Therefore, there'll be a trickle-down effect as per statistical studies, and next week's base is volatility is also expected to be a little higher. Do remember what I told you, my friends. Jensen's measure and the Traynor ratio for the Bank Nifty was not conducive for aggressive buying. The same applies for the Nifty 50. Don't get aggressive. This is not a time when you will bet your bank or sell your house and buy shares. This is simply not that time. I agree that the bulls are clawing back. I agree that LIC's IPO is a very, very morale boosting factor. I also agree that March, as I told you in my previous video, is a very special month in India because this is the last month of a financial year. And the mutual fund industry invariably comes and supports the market to boost their NAV so that they can basically, as per securities law, disclose their annual NAV in one national and one regional newspaper. So this NAV massaging or NAV boosting is expected to keep the markets higher, and LIC's IPO, of course. So friends, the index point done. I now go to the most popular segment of this video, wherein I give you 5 stocks which are high beta, high volatility, high impetus stocks, where you take small exposure, wait for large price moves, and 5 stocks that are low beta, low impetus, where you take big exposure, wait for small price moves. Different traders, different mindsets, and therefore strategies will differ as well. So the high beta, high impetus list where you take small exposure is led by Cipla. Number 2, Infosys. Number 3, Sun Pharma. Number 4, Syngene. Number 5, Colgate. And the low beta, low impetus stock list where you take larger exposure for smaller amplitude is led by Indus Tower. Number 2, Punjab National Bank. Number 3, Power Finance Corporation. Number 4, Amara Raja Batteries. And number 5, Apollo Tires. Friends, this hierarchy of stocks changes from hour to hour, day to day, and do keep connected with me on social media. My contact coordinates will come again at the fag end of this video so that you can update yourself. We'll connect with each other, help each other become better traders, and keep conversations going. Also, if you liked what you saw in my video, please subscribe to my YouTube channel. Click on the bell icon to receive instant alerts about fresh content being put about here. Good, bad, or ugly, I always welcome your comments in the comment section. Your feedback is always valuable to us. Also, please help us reach fellow like-minded investors and traders who are looking out to knowledge-based investments, data-based decision-making support systems, which is our specialty. This is what we do for a living. And share our videos with them so our message gets across. The market becomes a more efficient place to trade. Also, in the description below this video is a hyperlink to my playlist on Equity Masters YouTube channel. Please subscribe to that playlist as well, where I share 2 trading ideas a week. And there's a free trading guide in PDF format to be availed from Equity Master. Do grab that opportunity as well. Friends, thank you for your patience in watching my video. I wish you have a very, very profitable week ahead. Till we meet again in my next video, this is Vijay Bambani signing off for now. Take care. Bye-bye.